You want to profit more in your Amazon business? Well, today's episode is for you. This will help you out actually if you're in any business, but this one is really specific to Amazon and specifically applying the profit first methodology to e-commerce businesses. And today on the show, we have Cyndi Thomason. She's an expert in this area because she wrote the book Profit First for e-commerce sellers. So stay tuned. It's going to be an awesome show and it's going to help you profit more. All right, Cyndi, thanks so much for being here. Welcome to the show.
Thank you. I'm excited to be here with you guys today.
Awesome. Well, I know this topic is going to be a hot one for our Rainmakers because we are all about not just running a business, but actually having profit. And that's really what you specialize in, not just profit, but profit first for e-commerce sellers, because there's strategies that work for business. But I feel like e-commerce, we need to do things a little bit different because there's inventory and there's all these things. And so I want to kind of bring it back because some of our listeners may have heard of the book Profit First. Like I've read the book Profit First, but let's bring it back to like what even is this concept of profit first, and then we'll kind of get into the e-commerce side of things then. But let's bring it back to what is profit first to you.
Okay, Profit First is a cash flow, cash management system. It was developed by Mike Michalowicz, who also wrote the book Profit First. So it's a book that kind of explains all of it. But what it's explaining is this methodology. And the premise behind it is that, it's not all about the revenue that comes in. It's about what you keep in your pocket and making sure that as entrepreneurs, we're setting money aside to pay ourselves, to reward ourselves with profit in the business, to take care of taxes, etc. So it's kind of like the envelope system, if you will, but using bank accounts instead. So if your grandmother or had ever used envelopes to set money aside for Christmas or for vacations or grocery money or whatever, it's that kind of idea, creating bank accounts that have a purpose that helps you manage the cash going into and how it flows in your business.
Okay. Yeah. And I honestly like in the show, I love to kind of just play Curious George because I read Profit First and I was like, in the season I read it, it was just not a great time to like go implement it all. But the one thing I did take away was the separate bank accounts. And so I did create extra bank accounts. I didn't follow exactly the whole system, but I created like a couple extra ones. And I was like, okay, this one, I'm going to push money into. When money comes in, I'm going to push money into this one right away, a percentage. And then the other one was more like an operating expenses account. And that's really as far as I got with Profit First. And so I would love to dig into this more of like how this could work and specifically how someone could maybe set this up for their Amazon business. Especially we have a lot of listeners who are in that first year of Amazon. And I feel like having a system like this will be so powerful for them to really know where every dollar is going, but also feel empowered to like, I'm actually bringing money home from the business. Because I know when we first started on Amazon, we were also trying to pay off our house at the same time. And so like cash was going to inventory and cash was going into the house. And we weren't, it was all in the same bank account. And like, it was like, honestly, we had no idea where money was going. And so while we were making money on Amazon and it felt great and like, oh, I think the numbers are there, did we really know what was going on? We had lots of different stuff going on. And so I would love to dig into this. Like, so talk about the bank accounts thing first. Let's dig into that maybe. So first step is potentially creating these new bank accounts. And are they within the same bank or different bank? I know for me, I did the same bank, but I wasn't sure like how do you usually see people set it up?
I recommend doing it with the same bank. I think if you're good about not going in and taking money out of your accounts, the same bank works fine. If you're one of those people who's like, oh my gosh, I'm going to need money next week and you're moving it a lot, then put it in a separate bank. It's kind of like, if you're trying to diet, you don't bring the potato chips home, so you just have a little bit of separation between you and your money, if you will. I think the reason the bank accounts work is that you're designating a purpose for the dollars that are in those bank accounts. So if you say this bank account is for my inventory and you're building that up over time, and this bank account is to pay myself or my team and you're building that up, as you have those different bank accounts and you see them build and then get depleted when you spend out of them, you start to understand the rhythm of how cash flows in your business. When it's all in one account, it's kind of like vegetable soup. You look in there and you can't really say, oh, there's that many carrots and there's that many potatoes or whatever. It's just all mixed together. And it's really hard to distinguish what the purpose is or what the makeup is of those dollars. So by setting them aside, you can start to see, oh, that's earmarked for my inventory. I'm going to have to, place an order soon. I don't need to mess with that. It just helps you understand, what's available to use and what you really need to be setting aside to have dollars for later.
Cyndi, I would love to know. I love this idea of creating a couple of different bank accounts. So I'm just looking from the view of like a student coming in. This is their first year selling in e-commerce specifically. They do the bank accounts. And then when do they know, or is there a percentage that you recommend setting aside for inventory, for paying themselves? Like, what are kind of the next steps after they have set up those bank accounts?
Well, at the time that they're to the point of having bank accounts, needing to buy inventory, et cetera, they need to have understood from the purchase of the inventory, how much are they going to charge for that product? How much are they going to sell it for on Amazon? And what's the percentage that they're going to use to pay for that product? So basically, what is their cost of goods sold, if you will?
Mm-hmm.
So when you know what your cost of goods sold is, and let's just use 30% because it's easy, then you can say, all right, out of every dollar that I sell, I'm going to put 30 cents in this inventory, because if I have to replenish it, I'm going to need that 30 cents to buy the next round of inventory. So that's a quick and dirty way to figure out where to start just to get a replenishment amount. So if you can understand, I'm selling it for this much, this is my cost of goods, then set that much aside. Every time you get a dollar in from your sales, set that percentage aside into your inventory account. And that will be building up so that when you have to place that next order, you've got the funds available.
That's good. We do see that roadblock a lot of times where someone has a product that's doing well, but they didn't plan for that reorder. So then they have to slow down because they don't have enough capital to do the reorder. And so we started implementing, Kevin King he calls it the 2.5 rule. Have you heard that? A 2.5X, where it's
No, I
like
haven't heard that.
basically, he's like, if you have, let's say, $10,000 to invest in your Amazon business, don't spend more than if you divide 10,000 by 2.5X, 2.5, don't spend more than that on your first round of inventory, right?
Yeah,
Because that gives you, it's kind of like reverse engineering what you're saying, at
right.
least for the first order. It gives you that overhead to go, okay, I have enough for not just this round of inventory, but also any additional fees and PPC and things, but also the next round of inventory. Because
Right. Yeah. Kevin and I have talked about that actually.
yeah.
Yeah. And I didn't know that rule, but yeah. Yeah. My advice to folks is always have enough, when you make that initial investment, be able to make it twice. And so I think we're talking about kind of the same kind of thing, because as you sell through, the timing of that, as well as the timing of when you get your payout, as well as how much in advance you have to order, it just doesn't work out perfectly. You need to be able to have that, place that second order well before you've sold through your first order. So that 2.5 is a great rule of thumb, I think.
Yeah. Now, I love the idea of having a COGS bucket or bank account. I think one of the concepts, again, it's been a while since I read the book, but it's paying yourself first, right? Like kind of having a bucket that's like, this is my money, and I'm going to put
Yeah.
money in this, like from the business. That's how we're doing business, right? To like, let's create some overflow and actually designate it for yourself, right? And so, talk about that a little bit with, do you see common percentages that people start out at? I know some people don't pay themselves at all for a long time. But what do you see? I mean, I know you are a fractional CFO, you have that service, you have bookkeeping services. So I'm sure you have hands in a lot of different accounts.
Right.
What are you kind of seeing across the board?
Well, I'm looking. I got the chart in my book, so
Oh,
I'm going to
awesome.
look here because I don't have it memorized. But we do have the percentages laid out depending on how much real revenue is coming into your business. So to define the difference between top line revenue, which is your sales number, your number before anything comes out of it, and real revenue. Real revenue is after Amazon has taken their fees, after you've set dollars aside for your COGS, then those dollars that are left is what we call real revenue. And the cool thing about Profit First is once you get to a real revenue number, it doesn't matter what business you're in, the percentages are the same. So if I were talking to a dentist or a landscaper or, a retail store, the percentages are the same. And Mike got to those percentages by going out and interviewing successful companies. So once you're at that real revenue number, let's say you've set aside, you got $100 in and you've set aside your $30 to replenish, then the $70 can be broken up into 4 main buckets. The first bucket is the profit bucket, because of Profit First, we want to put dollars in the profit bucket. And for a small business, because I'm going to pull from that column, if you will, for fairly new businesses, 5% is what should go in there. And then the next, and let's be clear, profit is what you take out of the business as an owner. Like if you were investing in the stock market and you got dividends, those dividends and profit are kind of the same thing. Then the next bucket that we invest in is called owner pay. And that's to pay you, to compensate you for the work you're doing in the business. So you kind of wear 2 hats in your business, right? You're in there doing stuff, but then you're also the owner, and you should get rewarded for taking the risk and being an owner. So the profit bucket's 5%. The owner pay bucket is 50%, because for a business just starting out, the owner does a lot of the work. Now, as the business grows and the revenue grows, that percentage goes down for owner pay and the profit goes up. Then the tax is 15% across the board. It doesn't matter what size business you are. According to the research Mike has done, if you set aside 15% for taxes, then you should be covered. And then the final percentage is 30% for operating expense. So of that $70, that's our new whole pie, if you will, okay? Our real revenue pie. And then we're going to divide it up in these buckets with profit at 5%, owner pay at 50%, tax at 15%, and then OPEX at 30%. And honestly, the place where people struggle is the OPEX, because they really see lots of things they can spend money on as new business owners,
Yeah. I love that explanation. I feel like, because like I said, I did like Profit First light. Okay. So I'm very much a beginner at this. But I created the profit bucket and the OPEX bucket in our business. And I think I found myself probably about every month, I would just pull over some money into the profit bucket and I'd pull over some money into the OPEX bucket. But I didn't have like a strategic percentage around it. So I love that, like, just having rules to follow helps you kind of just be really consistent. I feel like this also makes it so much easier from a bookkeeping perspective to like know what's happening in the business, where you can almost like in those early stages of the business, likely DIY your bookkeeping for a while, right? Like do it yourself until the business grows to the point where it makes sense to do it. But like if you're compartmentalizing everything on the front end, it's way less complicated on the back end. And I love that. That's like, it's a little bit of structure, a little bit of setup, but then you just follow the rhythm and it creates simplicity.
Yeah, and you start to gather data about how things are actually going without actually having to look at your financial statements. And I mean, that's the business I'm in. But I tell you, I run my business day to day by knowing where my Profit First accounts are. I log in, I look at the bank, it's this much into the month, I've collected this much dollars. I know when payroll is going to hit. I just know, because those buckets are set aside for specific things. I just know where I should be. I don't have to look at financial statements, and I get the data a lot quicker that way, because part of Profit First is actually establishing that rhythm. And it suggests that people look at it like either once a week or once every 2 weeks. Because looking at it every day, like I do, is not the best practice, honestly. The best practice is to let things start to go through your system, check in every couple of weeks, and you see where you're at, and then you check in another 2 weeks. If you go in and do too much on a regular basis, so if you check in and decide, I'm going to pay this bill or I'm going to pay that bill, you are putting a lot of randomness into your accounts, and you can't really see, oh, this account builds up to here. Then on this day when I pay my bills, I take it down to here. once you get in these rhythms, you start to really see cash flow in your business in a way that you understand it. And, you know, one of the things I think is hugely important is that inventory cash flow is just really different than operating expense cash flow. Because most of the time your operating expenses are monthly. You're going to do your payroll, you're going to pay your bookkeeper, you're going to, pay for insurance, whatever it is. Those things happen typically on a very regular cycle. Whereas inventory, you may have to send a bunch of cash down as a deposit. Then you have to send a bunch of more cash a month later. And then you sell through and nothing goes out the door for a while as you build up dollars again. And when that's happening at the same time as you've got this monthly number that's consistent, it's really hard to see what cash flow is doing in your business. So separating those two things out allows you to understand cash flow is different for inventory than it is for your operating expenses.
Hey, Steven here. Sorry to interrupt your show, but I have an important ask for you. We love making our decisions off of data, and your opinion really matters. We would love to hear from you. Like, what do you want to hear on this show? Chelsea and I want to make this the most amazing experience for you. So what are the topics that you want to hear about? What are the guests that you want to hear on? What are the trainings you want us to go deep on? Like, we want to hear from you. So there's a number right here, 530-298-0747. Text the word podcast to 530-298-0747. You'll get a little autoresponder and it'll say, hey, what do you want to hear from us? And then text us back what you want to hear. We are watching those. We're taking a look at those. And so we would love to hear from you. And maybe your topic will end up on a show coming up soon. All right, back to the show. Good. I feel like this is kind of a mental shift for some people, because I know this because we had this shift too. I think when you're a solo entrepreneur and you're kind of doing your own thing, it's kind of like you are the business. And it's like all the money comes into the bank account. It's all mine. It's like, this is all my money. Right? And so it's like, oh, I built this. But I think when you start to separate the like, okay, this is the business's money and this is my money. It's a really powerful shift because you're actually starting to build like the valuation of the business itself. And you're also starting to pay yourself as kind of like, almost like an employee of yourself, right? Of the business.
Yeah.
And not only think I have advantages like from a tax perspective, but I think from just like like you said, like really knowing your numbers. So when it comes to like, I need to hire someone, right? You really know like, okay, I'm going to pay 50%. Now that's a pretty high amount. I have bandwidth to free up some of my time by giving someone 10% of that, right? Or whatever the number ends up being. So it's a really powerful shift. And I feel like for years, we just had everything kind of going in the same account, multiple businesses all into the same account. And then you get we'd work with a CPA and then reconcile the finances, and you're seeing numbers that represent like 2 months ago because they just did the books, but it was like 2 months ago data, and it's not good data, because it's good data, but it's like it's in the past.
Yeah, it's looking in the rear view mirror.
Yeah. So I love this like every week cadence, logging in, going like, here's my. So I'm what I'm kind of sensing is you have these delegated buckets, right? Bank accounts or envelopes, so to say, digital envelopes. But you must have one kind of catch-all, right? That's like the Amazon account is connected to the catch-all. Anything that, or like Shopify or whatever, it goes to the catch-all account. And then from there, you're shooting it out to the other accounts. Is that how it would work? Or do you have like one account that's like the main connection point?
Yeah, and there's a couple ways to do it. What I recommend for people that have Amazon is not to have a income account, which is like the serving platter or the catch-all account. So the income account in like for my business, all the money from our sales comes into an income account, and then we move it into different buckets. But if you're working primarily with Amazon, they're holding your money for 2 weeks. And so they're kind of serving as that income account, if you will. So then I usually say, put that into your operating expense account and then move the money from there. Because seems kind of, the whole point of having an income account is so that you see it accumulate and you start to understand the flow of dollars into your business. Well, Amazon's kind of serving that purpose for you. And so if you're primarily Amazon, most of what you're selling is on Amazon, I don't think it's necessary to have an income account because they're kind of holding your money and you can see it there and start to learn the flow that way.
Okay. Yeah, that's true. Yeah, we do a lot of stuff through Stripe as well. And similar thing, they'll hold the money for a week or two, And I actually have a widget on my phone that'll show the daily sales. So I can kind of see volume on the day-to-day basis, but then they're holding the money and then that's pushing over to the account in about a week. So it's a little behind, but having that real time, and I know a lot of our students, they got the Amazon app up every day, just like, how am I doing? How am I doing?
Refresh.
But it's hard because like Amazon, you make, top line and then you go into your kind of reserve and it's like, okay, we're taking this fee and the PPC. And so it's almost like it's kind of like a holding account, but it's also, it's taking out some of those, cost of goods sold, I guess, in the process. Would you categorize that as COGS, like basically the Amazon side of things, like the fees?
We
and
do. Yeah. I mean, when from an accounting standpoint, which is different from just watching your cash, but from an accounting standpoint, we do feel like the fees and merchant processors are COGS. Now, that's something we debate with other CPAs and accountants in the industry, because some of them go, oh, no, that's an operating expense. But our theory is, if this is your primary way of doing business, you're not going to be selling stuff on your storefront. And I mean, this is, a physical brick and mortar type of store. So this is the way you have product available for your clients or your customers. So we think it's a COGS.
Cyndi, I would love to know, what are some things that maybe you've seen in the e-commerce industry? Like, I would consider you like an expert in the space in accounting and bookkeeping. What are some things that you've seen from other accountants or bookkeepers that want to come alongside somebody who's in e-commerce that might not know the extent of what you do? Or what are some things to like look out for? Or like, are there any like red flags that you try and make people aware of?
We very often get new clients in and we have to clean up work from other accountants that, this is not their specialty. So some of the things that I see there is they don't understand how sales tax is being handled through Amazon, because sales tax is part of your product charges when it comes in to your settlement. And that's not real revenue. That should be moved aside into a sales tax account. It shouldn't actually hit the balance sheet the P&L at all. And so sales tax is an area we have to clean up because it's not put in the proper place most of the time. And then when the tax accountant goes to file the taxes, they're not sure why it's showing up in the 1099 from Amazon. Yeah. But if you look on the back, it tells you that their income number actually has sales tax in it. So that's an area that I think is very confusing just because of the way Amazon treats it. And unless you're into that, you're not aware of it. Another area is just really understanding the fees. We cleaned up a set of books last week where they booked the net, the deposits, the settlements in as revenue. And then they figured out there were also fees. And so then they took the fees out. So they had actually misstated the client's income by the amount of fees because they didn't gross up the sales. They used the deposit and then they took the fees out again. So you have to be sure you're paying attention to what's actually hitting your books. I think Amazon's fixed this, but I haven't gone back and actually verified it. But there is an Amazon Pay bank account, and then there's the bank account that you attach to your Seller Central. And so it used to be a fairly common occurrence where we would go into a new client's Seller Central account and there'd be a little warning flag on their bank account. And what we would find is when we go in there, we would see that they didn't actually have a bank account connected to their Amazon Pay. They thought because they had one bank account connected to Seller Central, that's all they had to do. Now, I think I have seen something recently that said going forward, they fixed that. But if you've got an older account, it's worth looking to be sure Amazon Pay has a bank account connected to it. It's really a happy day for us to be able to say, you've got $110,000 sitting in Amazon that you have not collected. I mean, we found that many times, and it's varied between $20,000 and $110 was the highest amount.
Wow.
Wow.
Happy day for
Yeah,
that
that is
client.
cool.
That's
That is
amazing.
fun.
Yeah, the bookkeeper found it at like midnight, and she says, all I could do not to text him.
Yeah, that's amazing. Well, I think this is going to be so insightful for our members and our community. I know we're having you come train in our inner circle and potentially even our mastermind. So, listeners, if you're not a part of those groups, definitely check them out. And Cyndi, we'll give you a chance to tell people where to find more information about, because I know you got tons of resources, courses, like your book, Profit First for E-commerce Sellers. Like, we'll definitely hit a couple of those things. But I would love to just check. We kind of gave a very basic kind of overview of the first steps, right? Create the bank accounts. Here's some percentages. Is there anything else that you recommend to someone who wants to start implementing this in their e-commerce business? Any other like kind of initial steps that are going to help get them in momentum?
Well, I'd kind of like to just give a few seconds on why it works, because I think sometimes we get involved in thinking about the tactical piece of how to do it, and we don't really understand the why behind it. And the reason it works is because there is a behavioral economics law called Parkinson's law that is behind how we actually think about money, or actually any resource. And so Parkinson's law basically says if you've got a lot of something, your expenditure rises to use more of it. If you have less of it, you are more efficient, you're more frugal, and you're more innovative. So when you look at a bank account that's big because you got everything going into one place and you haven't said, okay, I'm going to have an inventory payment over here, so I need to set those dollars aside, your brain looks at a bank account that's big and goes, "Ooh, we may be able to go to Disney World, or we may be able to buy those new computers, or whatever." We get excited and start figuring out how we can spend those dollars. So that's the theory behind why Profit First works, is because, and the other piece of it is the primacy effect. So what you see first is what you're going to pay attention to first. So that's why Profit First, that account is first in order for how you allocate for a reason. Because if you set that aside, you'll be paying attention to it. And then what's left in the OPEX bucket, you will manage to that bucket because of Parkinson's law. So those are the two main drivers behind behavior that make Profit First work for how we manage our money. And it's not really about learning a bunch of rules. I mean, you can set up and get these accounts working for you. I had one client, after we worked with him for a while, he had 23 bank accounts, but he knew as soon as shipping got lower than such and such percent, something changed. He needed to go pay attention there. So he used it kind of like a budgeting tool. But if you start very simply and get the rhythm of how it's going, then you can start to get more creative and set dollars aside for things that you want to pay close attention to. Like advertising, I think, is a great one to pull out and pay attention to. How many dollars are you spending on advertising, especially if it's separate from what Amazon is, if you're not having it deducted automatically.
Powerful. Thanks so much for explaining that. I think like seeing too, I think that it not all being in one account where you're like, one day you're having a great day and there's tons of money. And the next day you're like, where'd all the money go? Right.
Mhm.
I remember hearing an e-commerce guy speak on stage, and he was talking about the first time he hit $1 million, and he went to his wife, like, we hit $1 million in our business. And she was like, where's the money? They hit $1 million, but like they had spent so much, there was no money in the bank account, And so it's funny, like you can kind of go on these roller coaster of emotions if you're just having everything in one account. Having even just that Profit First account, it's so nice to see that consistently growing. Even if it's a tiny 5%, it's that little bit that grows and grows and grows. And it's like, yes, this is worth it. Keep going, keep going. And it gets bigger and bigger over time. So thank you so much, Cyndi. Like, this is so awesome. And we're excited to have you in our community more and train more on this topic. Where can people connect with you though, if they're not in one of our communities? Like, where can they connect with you online? What's the best place to send them?
We're on Facebook and LinkedIn primarily. I think there's a Twitter account, but I'm never there. I can't figure it all out. But I have a ton of resources over the years. My book is over 5 years old now, which is kind of hard to believe. But I have a lot of podcast recordings, a lot of webinars that I've done over the years. And we've actually put together a hub page where if you're wanting to start Profit First, you can go to that hub page and get the guide. And all of the resources I've created over the years are in the order that you would need them. And that's at bookskeep, BOOKS, KEEP.com. And there's a resources page there where all that is at.
Okay.
Awesome.
Awesome. We'll put that in the show notes. And thanks, Cyndi, for being
Yeah,
here.
thank you.
Thank you for listening, Rainmaker family. We'll see you guys on the next episode.
Thank you for listening to another episode of the Rainmaker Family Show. If you're not a part of our mastermind yet, I want to say I think you're missing out. Our heart here at Rainmaker is to create total abundance for you. That's why we're offering a free one-on-one family freedom design session for you, our faithful listener.
Yeah, if you want to hop on a call with our team, see if it's a good fit to build a business that creates time freedom for you, financial abundance, and helps you leave that thriving family legacy. That's what we're all about in our mastermind. You can grab a time on our team's calendar at rainmakerfamily.com/mastermind. Again, that's rainmakerfamily.com/mastermind.